A corporate budget is a blueprint. It translates an organization's strategic objectives into strict quantitative targets, establishing a precise baseline for evaluating operational performance. But a baseline only matters if you measure against it. Variance analysis provides the feedback loop. It isolates the exact mathematical differences between those budgeted expectations and the actual costs incurred or revenues earned. The results of this analysis fall into one of two categories, based entirely on how they impact the bottom line. A favorable variance, denoted by an F, increases income. An unfavorable variance, marked with a U, decreases income. The problem arises when these deviations are rolled up into high-level executive reports. Presenting a total overhead variance as a single consolidated number effectively hides the actionable data needed to fix the underlying issues. To take meaningful corrective action, management must mathematically decompose this total variance into 4 specific components, divided across 2 distinct cost behaviors. Deconstructing this single overhead figure is the only way to separate daily inefficiencies on the production floor from the broader executive-level problems of capacity planning. Variable overhead, or VOH, are costs that flex proportionately with production output, like electricity to run machines or indirect materials consumed during assembly. This table details Chowdown's variable overhead variances. Planned output was 18,000 units, but actual was 16,500. Standard processing time is 1.2 machine hours, but actual usage crept to 1.3. Finally, the standard application rate was $8 per hour, while the actual rate was $10. The variable overhead spending variance subtracts the product of the budgeted application rate and actual allocation base from actual variable overhead. Applying the Chowdown data, we multiply 21,450 actual hours by the $2 difference between actual and standard rates, resulting in a $42,900 unfavorable variance. Behaviorally, this unfavorable variance measures price control over variable inputs. It evaluates what the company paid per hour, independent of the worker's total time. The second metric, the variable overhead efficiency variance, isolates the actual usage of inputs, like machine time or materials, rather than the price paid for them. To calculate this, we multiply the budgeted application rate by the difference between actual allocation base and standard inputs allowed. We multiply the $8 standard rate by the difference between 21,450 actual hours and 19,800 standard hours. This yields a $13,200 unfavorable efficiency variance. A strict rule applies. Applied variable overhead always equals the flexible budget amount for the actual output. Unit variable costs are assumed constant within this range. Breaking variable overhead into these 2 variances lets management identify capital lost to inflated input prices versus capital drained by wasted time on the factory floor. The second half of the model involves fixed overhead, or FOH. Because fixed costs act as lump sums regardless of short-term production volume, they require a different mathematical treatment. This is the fixed overhead variances table for Chowdown. Notice the contrast with variable overhead. Here, the static budget and the flexible budget amounts are identical, both sitting at $450,000. This identical budgeting occurs because fixed costs do not flex with volume changes, provided that actual production remains within the company's relevant range, the normal band of expected operational capacity. The fixed overhead spending variance is simply the actual fixed overhead minus the budgeted fixed overhead. Chowdown incurred $429,000 in actual fixed costs against a budget of $450,000. This straightforward subtraction yields a $21,000 favorable outcome. Warning tone: production efficiency does not affect this variance. There is no such thing as an efficiency variance for fixed overhead. Instead, we look to the fourth and final component of the overall model, the production volume variance. The production volume variance is defined as the budgeted fixed overhead minus the applied fixed overhead. Taking the $450,000 budgeted amount and subtracting the applied amount, which is the $25 rate multiplied by the 16,500 actual units, results in a $37,500 unfavorable variance. Behaviorally, an unfavorable volume variance means fixed overhead was underallocated. The company incurred costs for unused capacity because they produced less than the system budgeted for. This volume variance is rarely the production manager's fault. It points towards the sales staff failing to meet targets or an uncontrollable administrative shutdown. Executive management doesn't always need a four-part breakdown of every discrepancy. Accountants can modulate the resolution of their reporting depending on a manager's authority. What we just constructed is known as four-way analysis. It is the complete baseline, keeping all four overhead variances strictly isolated. The first level of aggregation is three-way analysis. Here, variable and fixed spending variances combine into a single total spending variance, while efficiency and volume remain separate. The next level of compression is two-way analysis. This combines all spending and efficiency metrics into a single flexible budget variance, often called the controllable variance. This two-way model perfectly separates the operational factors the production manager controls from the production volume variance, which they do not. N-way analysis empowers organizations to tailor the feedback loop, ensuring specific managers are evaluated solely on the variances they actually have the authority to influence. This graphic displays a finalized variance report. Observe the equation headers: actual quantity times standard price and standard quantity times standard price. These top-level inputs filter downward, driving the final tax. The bottom formula combines these into a total overhead spending variance of $3,250 unfavorable. Variable overhead yields spending and efficiency variances based directly on changes in production output. Fixed overhead, meanwhile, yields spending and volume variances based strictly on capacity utilization. This mathematical framework allows modern organizations to manage by exception, focusing executive attention only on the exact variables that deviate from the plan. By mastering these specific variance derivations, management stops guessing at the causes of budget overruns. They can accurately pinpoint whether a loss is a temporary operational failure on the floor or a structural, strategic shortfall in corporate planning.